Thanks for tuning into our weekly investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So let's start with a look at market trends from last week. The S&P 500 gained 0.9%, and that took the year-to-date gain up to around 24%. Small cap stocks were a particular bright spot last week. They were up 1.9%. And what was driving that was really strength in financials. Small cap indexes are much more bank heavy than the large caps, which tend to be more tech heavy. Driving that strength in the financials was the heating up of the third quarter earnings season. We have results from 27 different large cap financials companies. And in that sector, that represents about 45% of the market cap. And thus far, results have been very solid. Earnings are up almost 6% for the financials, which is a significant positive surprise relative to what analysts had estimated coming into the reporting season. For now, only about 16% of the entire S&P 500 is reported. But again, surprises have broadly been to the upside. Now, we'll continue to follow along as that earnings season develops here in the upcoming weeks. Now, as long as earnings are expanding, historically, the market's been able to avoid major bear markets. So that'll remain something to watch. Now, from a macro perspective, the most important release last week was probably retail sales. It showed that, especially ex-gasoline, retail sales were quite strong last month. Now, one of the categories that was reported, it's called core discretionary retail sales, and that correlates very tightly with the consumption calculation in U.S. gross domestic product, or GDP. Now, that measure of core discretionary sales was up 0.6%. That's a pretty strong growth rate. And now the Atlanta Fed's GDP Now calculation for the third quarter is estimating economic growth is going to be about 3.4%. Now, that's a very fast rate of growth for such a large advanced economy like the US. Now, with the election looming, it makes sense to us that we're getting more questions about policies. And one thing that keeps popping up is the US fiscal deficit. Now, both candidates have outlined policy mixes that are likely budget expansionary or adding to the deficit. The US deficit and total debt picture, that's really a complicated issue. But many of the market pundits that you hear, they attempt to picture it as very binary or black and white. A few points we'd make. First, the US has ran an annual deficit for the majority of time since World War II, really only balancing that budget for a short time in the 1990s. Today, the deficit is running about 5% of GDP, which is large, but not unprecedented. One important thing to note is that in real time, an expanding deficit has actually been a tailwind for stocks. We have to remember that Uncle Sam's debt is someone else's investment income. Rising deficits tend to be expansionary in real time. Now, the concern is more long-term in nature. If the deficit crowds out future productive investment, that could weigh on future economic growth. Now, sometimes we hear people tying the deficit to inflation or to US dollar debasement. There's no economic rule that a rising deficit causes inflation. It really depends on where the spending is and whether that spending is stimulating demand, which can't be met with supply. And that is pretty much what happened in the aftermath of the pandemic. But today, supply chains are much more normal and demand has normalized. Now, on the dollar, we note that the US remains a massive net importer, especially of goods. Now, in that world, the exporting economies are receiving dollars, and as such, the vast majority of global transactions remain tied to the dollar. The net trade picture is much more of a driver of dollar dominance than the federal budget. But even if the dollar lost its dominance in the future, it would likely be a very slow process, and corporate executives may have time to adjust to any impacts if there are any at all. Regardless, like many topics, the deficit and the policies of the next 4 years will require nuance. As for what we're watching in the week ahead, We'll get a flash estimate of growth for the service sector and also the manufacturing sector for the month of October. Also, we'll get some data on new and existing home sales. One trend we expect is something of a pause in a lot of the activity indicators, especially capital intensive industries, until the uncertainty of the election is behind us. That could mean that later this week, we'll get a soft manufacturing purchasing managers index print. We'll also watch jobless claims data as we do every week to gauge the health of the labor market. So tune in next week to hear our take on that data and much more. And as always, thanks for joining us and have a great week ahead.